Hey, what's up, everybody? I'm Eric. Today I'm going to talk about three things that I think you should avoid when you're starting your wealth building journey and three amazing mutual funds that maybe you should consider. It seems like everywhere I look these days, whether it's YouTube, TikTok, any of the socials, you see a lot of people pushing options. This is the first thing that I think you should absolutely avoid if you are new to investing. A quick example. Here's a book that I have on options, right? This book is 1,000 pages long. So the question you have to ask yourself, if somebody's pitching you options, have they read a book like that? Do they understand what's in it? I certainly haven't, and none of the results that I've gotten have been through things like options. So I certainly don't understand options to any more than just a fundamental degree. I suspect that the person that is pitching those to you probably doesn't even have a fundamental understanding. If you don't understand the investment that you're buying, don't do it. So the next thing I think you should avoid as a new investor ties into the first one, and that is don't try to day trade or pick individual stocks trying to hit a home run. When I was younger, I tried this over and over and over again, and I wish it was something that I would have just skipped in its entirety. I wasted, probably a couple of years, luckily not a ton of money, but enough to realize that trying to pick the next hot stock or thinking that somebody else has the ability to pick the next hot stock is just not a realistic approach. It's not true. If you check the statistics on fund managers, so people that are Ivy League educated, they have billions of dollars in the portfolio that they're managing, 85 or 90% of the time, those people are not able to beat an index. So like the S&P 500 or the NASDAQ, whatever the underlying index is that they're trying to beat, 85% of the time or more, they're not able to do that. And the longer duration that they try to do that for, the less likely it is to happen. Again, trying to pick individual stocks is really just a fool's errand. Stop. So just be really skeptical of anybody online that's telling you that a specific investment strategy is a sure thing. It doesn't exist. So the third thing I think you should avoid as a new investor is crypto. If you want to invest a little bit in Bitcoin or maybe a couple of the other, kind of top tier coins, the top three coins, I can see that a little bit, but there seems to be so many stories about just pump and dumps, the rug pull, over and over and over again. The crypto market just seems to be far more erratic than traditional investments like, stocks and mutual funds, ETFs, things like that. Definitely people out there that have made some money with these, but I feel like the people that lost money far outweigh the ones that came out on top. So let's get into a few different mutual funds and ETFs that I think could be a good fit for anyone just starting out. So real quick, a mutual fund is just a basket of stocks. So just think of when you buy one mutual fund, you're really buying into hundreds of companies just all with one buy instead of having to do it, hundreds of times, right? So the first mutual fund that I'm going to share with you guys today is just an S&P 500 index fund. I'm sure you've heard of these before. If you haven't, it's just a basket of the 500 biggest companies in the United States weighted by how big they are. Specifically, the one today we're looking at is FXAIX. This is one that I have been buying for probably over 20 years. It's a really big part of my portfolio. I've held for quite a while. I have returned over 70% in this particular account, which is almost $90,000. So let's take a look at FXAIX. This is a really common mutual fund. The other point of a mutual fund is to spread your risk around, right? So when you buy just this one mutual fund, it's going to go into 500 companies or thereabouts. And it's going to spread that money across all of them. So let's take a look at some of the things that they're invested in. I'm sure these are things that you'd like to invest in, and you can do that all just by buying this one mutual fund. So it's invested in Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Google, which is Alphabet, Tesla, Berkshire, and many, many, many more. An S&P 500 index fund could be a great addition for any investor. The next one I want to look at is FMDE, which is pretty similar. Let's take a look at FMDE. So this one, I have had a 56% return and almost $21,000. So this one is a mid-cap index. So this one just tracks a big basket of companies that are considered to be in middle ground of value. So usually it looks like between $2 and $10 billion valuation. So this one isn't going to have the big players like Facebook and Google. It's going to have some smaller ones that are still not very small. Roblox, Marathon Petroleum, Carvana, 353 in total. Allstate, Garmin, Carnival, Ford. The list just goes on and on. So there's 353 in total in this fund. So this one is the small cap Fidelity fund, and you guessed it, this one is just a basket of stocks of companies that have a smaller market value. So it looks like this one in particular has over 2,000 different holdings in here, and the top 10 only are 3.7%. So most of these companies, to be honest, I haven't even heard of. So you're probably not going to recognize a lot of the company names in here. They're too small. They haven't grown to be household names yet, right? But they could have the potential to take off. So the small caps have the potential sometimes to take off like a rocket, right? You know, if there's a business that's able to expand rapidly, sometimes you hit a couple of home runs. But then there's some other ones too that kick the bucket and don't make it and go out of business, right? Over 2,000 in this one, so if any of them ever take off, that's great. Hopefully the winners outweigh the losers. So I'm 42. I've been investing for over 20 years, and index funds have been a huge part of my portfolio. They've made me hundreds of thousands of dollars. I think they're a great investment. So I'm 42 now, and every time I've gotten paid over the last 22 years or so, I was investing in mutual funds over and over and over again. And as time went on, they compounded and compounded and compounded. This strategy works so much better for me than ever trying to pick stocks or the next hot thing. So if there was a tip that I could leave you with, it would be start young, invest in quality things like mutual funds, do it over and over and over again, never sell them. To me, the recipe has been that simple. Buy them over and over and over again and never sell. I hope that this was useful to you. If there is anything I can do to make something clearer, please leave a comment. I will reply. I appreciate you sharing your time with me today, and I hope to see you again.